Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. As we do each and every week, the stocks you see on the screen will be the stocks featured in this recording. And if there's a particular stock you're interested in, you can go directly to it using the chapters feature in this recording. All right, let's get to the markets right away. Typical Friday from the past few weeks. We had a rally today that did hold into the close, but don't get too excited. As you can see, even on the high of the day, we didn't even get close to the 10-day moving average. So we were a little bit oversold. So a bounce was to be expected. I know a lot of traders were looking for a bounce yesterday, but that didn't happen. The bounce happened today, and maybe we get a little follow through at the beginning of next week. We'll have to wait and see. But one thing to note is this Elliott wave pattern has changed again, a second relabeling. So all you Elliott wave haters out there that don't like the relabeling are going to have a field day with this. But one of the things that I can tell you is the great thing about Elliott wave is that it relabels. The market's dynamic. It's not static. It's ever changing. If you don't have an indicator that's quick to change with the market, you're going to get left behind, and you could be in a losing trade for a while before whatever your favorite indicator is catches up with what the market's doing. So I like the fact that the Elliott wave relabels. And normally when you have a relabeling, the subsequent pattern has a higher percentage chance of occurring than the original one did. So that's kind of a unique thing about Elliott wave. And in this case, this is a second relabeling. And what I mean here is now there's no pattern. Before we had the 3 here and we had a 5 here and then the 3 moved over here, and now there's no 5-wave pattern at all, which means we're in a corrective phase. So this is an impulse move to the downside. I've talked a lot about how I use zigzag patterns within the wave 3. So much education out there in the Elliott wave world of stay away from wave 3s, even though everybody widely regards it as the strongest of all waves. It's hard to figure out where the wave 3 is going to go. And I disagree. I think if you have a zigzag in the wave 3, you have a really good idea where it's going to go with those fib levels. But the one pattern within Elliott wave that is difficult to figure out is where does an A wave impulse end? So now that we don't have a current 5-wave pattern, impulse pattern, we're in a corrective pattern. So this is an A wave impulse down. So we were due to bounce and form the B wave. Did we start that today? Maybe. We'll find out at the beginning of next week. But we still have more work to do just to get back to the 10-day moving average. So before we go further, I got a couple more things to talk about on the SPY chart. But we did have some economic news this week. The CPI report came out on Wednesday, and that was going to be heavily watched. How's inflation doing? The consumer price index. And as you can see, the headline number was a little bit better than expected. The core came in year over year, which is what the Fed looks at, even though the PCE is their favorite indicator. We'll get that at the end of the month. But when it comes to the CPI, they don't pay attention to the regular number. They look at the core, which is X food and energy. They throw those out because we don't pay for gas or energy or light bills or anything else. I'm being sarcastic, obviously. I don't understand why we even have a core CPI. The excuse is that those are a little bit more volatile. But it was still year over year at 3.1, even though the headline number was slightly better than expected by 1/10. So I don't think that the Fed is going to be in any hurry to start raising rates, even though the Fed Fund Futures is now priced in a 25% chance of a rate cut in June. Remember when we were just talking not long ago, there was going to be maybe one cut, a 25 basis point cut in December, and then we went to maybe 2 or 3 starting in September. Now we've moved that to maybe a 25% chance in June. I still think that's optimistic. I don't think the Fed is anywhere near ready to pull the trigger. And they say they don't care about the market with this big move down. They are watching the labor market, though. So I guess we pay attention to the next job report that comes out. But June, I think that's a little bit aggressive. So we'll see if we get a further bounce back to the upside here. And going back to the charts, we did break through that 570 level. So that was support. You can see how it held as support back in the September-October timeframe. It was tested again in November, and then we broke higher. We had that 3 and 5 that relabeled, and we came down. I thought we might spend a little more time here trying to hold 570, but we didn't. We broke right through it. And as we talked about over the last couple of weeks, if we didn't hold 570, the next big level of support is down here at 540. And you can go back and see how we held that back in the July timeframe. We broke through it in August, but we got back above it, tested it again in September. So we're kind of in no man's land right here. I think there's a good likelihood we are going to see 540, but do we get that B wave bounce first in this zigzag pattern? That's again what we'll be looking at the beginning of next week. So that's where we are on the SPY. Let's take a look at the Dow, the DIA, and it had been really trying its best to hold this 420 level. It had done a good job for a while, as you can see, and then it finally gave up the 420 level. Now, it's also in no man's land as well, even though it's a slightly different pattern. This one is labeled as a wave 3 to the downside, which is kind of interesting. The patterns look fairly similar now. We had this big flat that I highlighted there, and then we broke below support. But the next level of support's down here around 400, which is pretty much the same time frames as those levels I was just talking about on the SPY. So we are below the 10-day moving average, almost the same amount that we are on the SPY. So do we bounce back up to the 10-day moving average first before coming down to 400? I think there's a good argument that we're a bit oversold for a while. The volatility has gotten higher. We'll look at the VIX in a second, and maybe this is where we get that B wave bounce. But that means then that we still have the C wave extension to the downside. And remember that all 5-wave patterns start with a zigzag. Every single 5-wave impulse pattern starts with a zigzag. Not every zigzag becomes a 5-wave pattern, though. So that's a little slight distinction there. Let's go ahead and look at the Qs. Now I'm going to go ahead and look at the VIX first. Sorry about that. We'll look at the VIX first. Then we'll come back and look at the bond market, and we'll look at the Qs and the IWM. But you can see that we did have a spike up to 30 on the VIX. We talked about this last week as well. You can go back and watch the previous recordings here on how unusual this move was here. Normally when we get higher volatility, these big spikes. And when you get a big spike, then all of a sudden we get pullbacks in the VIX, which means we get bounces in the equities market. In this case, we've had this kind of a trending move up on the VIX with pretty good sized bars, meaning good intraday volatility. It's been fun if you're a short-term options trader to take advantage of this intraday volatility, but we haven't had the big spike like we did back here in December. Do we need that? Do we need like a just blow off top on the VIX with a big washout move to the downside in the markets? Perhaps that comes with the C wave extension. But this kind of a churn here to the upside. One of you posted a comment last week that you're right about that. It's unusual. It is unusual. I've been watching the markets for 27 years, and I used to trade the VIX back when it was on the OEX instead of the SPX. So I know this is unusual. And then the only question was, is this move to the upside with increased volatility enough to give us a rally in the markets, not just a bounce, but a rally without the normal big spike? And I think the answer is no. That's what we found out. We've just come back down to the 10-day moving average, just like any other security. I talk about this all the time. No security in any time frame moves very far away from its 10-day moving average for long. So we got above the 10-day moving average. We came back down to it. I feel like there's probably some more downward moves ahead. Whether or not we get that B wave correction move to the upside in the equities markets first or not, we'll have to wait and see. So we'll do the bond market, and then we'll move into the Qs. So here's the TLT. This is a 20-year. And again, remember, this is prices. Prices and yields move inversely. So when prices go up, yields and rates go down. We had this triangle right at the bottom of a wave 5. When you end a wave 5, you have one of the corrective patterns, a flat, zigzag, or triangle. And people get really confused on zigzags because it's labeled as a corrective pattern. When I talk about trading a wave 3 zigzag, and like, why are you talking about a directional pattern of a zigzag? It's a corrective pattern. It's just the labeling of it because it normally shows up after wave 5. I'm just saying that if you can find one in a wave 3, now you have a good opportunity to trade the strongest of all waves. So we finished this wave 5. We went into a triangle, one of the patterns. We broke out, and we're consolidating again on TLT. So TLT has been kind of, as far as the mid-range on the yield scale, just kind of going sideways. You would think that would be constructive for the markets. You guys ask if I don't show it, the TNX, so I'll go ahead and show that. Now this is yields and rates on the 10-year. So the chart's going to be the exact opposite. So TLT is prices, TNX is yields. And again, the same pattern. We had this perfect zigzag pattern move to the downside, and we've gone through a consolidation here. You could argue that maybe the TLT, the longer end of the yield curve, is a little bit ahead, but we are forming this triangle here. So this movement here in the bond market has calmed down, but that hasn't been enough to satisfy the equities markets. I think there's more going on. I'm so tired of the tariff talk. The market has priced in the worst case scenario of tariffs by now. What the market doesn't like is that the tariff stuff changes. I went through that before last week, so I won't go through it again. The uncertainty. Markets don't like uncertainty. But if we came out with a really defined, these are the tariffs, this is what we're going to do without any changes, the market would be okay. It'd handle it, it would adjust to it, and then we'd move on. But it's the fact that it seems to be ever changing from a day-to-day basis that's creating this uncertainty in the markets. So that's where we are with yields and rates. So you can see rates have come down. So prices went up on the 20-year. That means yields have come down, and prices have come down on the 10-year as well. So even though they're slightly different on the yield curve, they're kind of in concert there as far as the direction that they're moving. So let's go back to the Qs, because remember, tech stocks are interest rate sensitive. And you would think there's actually some commentary talking about that this week on the financial networks, that you would have thought with the bond market calming down and rates calming down, that would have put a bid under the Qs, but it hasn't done so. You can see we still have this big move lower, almost identical to what we've had in the SPY. The only difference being we're a tad bit closer to the 10-day moving average, but not much. They're very similar. We do have a 5-wave still labeled here on the Qs, where we don't have on the S&P anymore, but on the wave 4, we're right around that 61.8% level. So maybe that gives us a little bit of a bounce. I don't think this is going to be a wave 5 move to the upside. I do think we need to test lower first before we have a washout and then a real sustained move higher. So any sort of a move to the upside, I think, is a selling opportunity. So you watch for the bounces and sell into the bounces. I think that's where we are. And then you go back and look what's likely to happen if this pattern relabels, is that on the Qs, we retrace this entire pattern. The first level would be 450. Maybe we can hold there at 450, even after a bounce, and we come back down. If we don't hold that, then we retrace the entire pattern, which very well could happen, which is more in the 430 area, so a little bit lower than 450. And the IWM, the small caps, the ones that are really rate sensitive, and I talked about this in detail a couple videos ago. You can go back and watch the past videos. I just don't want to hash out the same thing every time here in respect for your time when you're watching these. So the IWM had this really well-formed zigzag pattern. Look at this. So there's the A impulse. That, again, is the one that's hard to predict. That's what I'm wondering if that's where we are on the SPY. And then we had the bounce, and then the C wave extension. So we bounced in the B wave to 50%. That's going to yield 100% extension. And we've been holding there on the IWM. You could say, you could look at this both ways. You could say from a bullish standpoint, hey, we haven't gone lower like the rest of the markets have here. We're kind of consolidating. That seems to be a point where we could hold this 100% extension and then bounce to the upside. The negative would be that we're right at the 100% level. We've just gone sideways to satisfy a slightly oversold condition from the 10-day moving average, and we're destined to move down here to 161.8. So you could make a good argument for an upside or downside on the IWM. So we're kind of in that period of flux right now. Where the market's going to go, it's hard to discern, but they are not in concert. We had a small period of time where the bond market and the equities market were moving the way they normally do. We'd gone through that long period of time where the equities market was completely ignoring what the bond market was doing, the inverted yield curve, et cetera. And then they got back in correlation together, and now they've separated again. Can we hold this 100% extension? Maybe we do. Maybe we just bounce back to the 61.8% level, because part of the C wave extension rules on a zigzag is you test the previous fib level before going to an extended level. And again, just to emphasize this, the zigzag has done what it's supposed to do. We had a B wave at 50%. It's supposed to yield 100% extension. That zigzag did exactly what it was supposed to do. Spot on. Now, oftentimes, you do have an extended C wave where the C wave moves past the expected level and goes to the next fib level. But normally, before it does that, it will test a previous fib level. Nothing's 100%. It doesn't do it 100% of the time, but oftentimes it does do that. So perhaps that's what we're going to see here. If we do get a bounce in the SPY and the Dow, maybe the IWM goes along with it. So pretty interesting stuff going on there. Let's take a look at the metals before we get into crypto. So we'll start off by looking at gold. So we'll take a look at GLD. We look at GLD and you can see that big move to the upside again. Look at this. GLD is famous for this. I made my name in the world of options trading by coming up with a very unique way of doing strangles. Normally, when you go out and look, you see a straddle's buying a call and a put at the money. A strangle's going one strike out of the money on the call and one strike out of the money on the put. But I look at the delta curve, and we create our strangles based on where we're going to get the best delta gamma relationship on the delta curve. It's not one strike out of the money. But looking at triangles, the GLD does this all the time. Consolidate, break out, consolidate, break out. And it did it again. So we had this big triangle, which gave us this big breakout move. And then we consolidated again, smaller triangle, but still works. Even Elliott said, don't diss the small triangles. Pay attention to them because they break out as well. And we have broken out on GLD. Maybe that's the end of it because, again, this was a smaller triangle. So perhaps that's as far as we go on GLD. And we pause a little bit. I had mentioned that because this wave 3 was green, the algorithm in this software, and by the way, if you haven't gotten a copy of the software, go to hub.com, HUBB.com, and get a copy of it. You get free Elliott wave labeling exactly as Ralph Nelson Elliott wrote the algorithm. That's how this one's programmed. There's a lot of different Elliott wave softwares out there with personal adaptations. This is programmed to the algorithm as Ralph Nelson Elliott wrote it. And I've tried them all that I know to exist, and I like this one the best. But one of the rules that you learn here from the software is if this is not a solid color, like I have them purple for a confirm wave, if it's still green, that means it's still the active wave, and that meant the algorithm wasn't sure the wave 3 was done. It was over here, if you remember. So then we consolidate, we break higher, and the wave 3 moved over. So it was exactly spot on correct as far as what's going to happen. Now we'll see if there's any legs left to the GLD. Again, we're separating from the 10-day moving average a bit. Maybe that's the end of it. Now we go to SLV. And if you've been watching, SLV was actually our case study consideration in TradeFinder this week. And if you haven't signed up for TradeFinder, you can do it using the link on your screen. We do it every Tuesday at 1 p.m. Eastern time. So it's live during market hours. We look at the markets, we look for trade ideas, and we have a live Q&A. And in February, every single case study consideration was a winner. They were all profitable. So we had a home run month in February, and we're off to a good start in March with SLV being our case study consideration of last week, moving to the upside. We didn't do a strangle. We just said it's going to move higher, and it did. It did move to the upside here. So that worked out really well. While I'm talking about the free things that we do, and TradeFinder's free, we have a seminar coming up on Wednesday, April 19th. It's going to be what the AI outlook is for March, the rest of March, and moving into April. And that's going to be on Wednesday, March 19th at 9 p.m. You can see a link on your screen here. The link will be underneath this recording. You can register for it there. Again, it's free, and show up. And if you've been watching, you know how accurate the AI has been. Those signals that we did in February were all from the AI generated. What does it say is going to happen the rest of the month and any potential opportunities? So join us on March 19th, next Wednesday at 8 p.m. Eastern time for that event. I'd love to have you in that as well. So we do our best to give as much free education as we can out there. So SLV broke up, so that's another winner. So again, March is doing really well as far as where we are with our case study consideration. Moving to energy, we'll look at the UNG. We talked about this. It finally had a bid, and it got a bid in it because all of these data centers that are going to be built for the AI, et cetera, are going to be using natural gas to power them. So it finally put in a nice bid to the upside. We had this nice move higher. It was a wave 5, it relabeled. And we have the 3 here that's green. So again, the algorithm, not sure this is done. Remember what that GLD chart looked like. So is UNG going to follow suit? There is a caveat here of uncertainty on natural gas because, okay, it put a bid in it because they're going to be using them, but How long is it going to take to build these data centers? How much natural gas is each data center going to use? So there's not a lot of knowns there, but it was enough to put a bid here. We had a little bit of a correction back to the 10-day moving average. We went sideways here. Do we break higher? Do we take out this wave 3, or do we consolidate further here? And that wave C is finished in this zigzag within the wave 3. We'll have to wait and see on what occurs there in natural gas. So let's go to oil. In the energy markets. And you've been watching this, or if you have been, you've heard me talk about it. I do think this big trading range, I'm not going to rehash all that, is going to be where we are for a good part of this year. So I don't think we're anywhere near done staying in this trading range between 80 and call it 67.5, 65, somewhere in that area where the big triangle was. So we had the big symmetrical triangle. We broke out, went exactly to where we should have from the width of the triangle, even though I was a little surprised we broke 80. We came back down. When one of these corrective triangles breaks out, you come back and you test the point of the breakout. Not only are we testing the point of the breakout, we're consolidating into another smaller triangle right at the point of the breakout. So again, really classic Elliott wave stuff here. So we're going to get a breakout here in USO, but it's not big. It's not going to be nearly the size that we had on this big triangle that had its point right around January. So we'll get a little bit of a move, but it's not going to be enough on its own to either break above 80 or down below 65. So we're just going to have a little bit of a break somewhere in this big trading range on oil. So I think if you wanted to put a big iron condor or something along those lines on oil, I think it would be difficult to do a counter because we would need it to peg right here at 72.5. We came back here. It's a level that it's traded through even when it was creating this large triangle, but it's been trading right at this point for so long. I don't think a calendar is the way to do it, but perhaps a big butterfly or an iron condor, something along those lines. The problem is that the trading range is so large, it would be a little bit pricey of a trade, but I think it could be a really good one. All right, so that covers the metals, etc. Let's move into crypto. We'll go look at Bitcoin. You know the deal here as well. 2 Sundays ago, or a Sunday and a half ago, for this is Friday, we had the news come out on what stocks were going to be, or excuse me, what cryptos were going to be in the strategic reserve. I don't know why they announced that, but they did. I had said I don't think they would, because why would they say what's going to be in there, cause the prices to tick up? And then the government would have to pay more for those cryptos. But they did it anyway, and we got the big pop, but then we came right back down. And so in Bitcoin, we're consolidating right in this range here between 75,000 and 87.5. So you can round it off. Between 75 and 85 is the range we've been in for the last couple of weeks here on Bitcoin. Now, one of the things that is a question, how much is the government going to buy for the strategic reserve? And then the information that we got is like, oh, it's going to be over a 5-year period. So it's not going to be like this massive buying all at once. It's going to be a slow accumulation, kind of like the way an institution would accumulate a position in the stock. So that was a good opportunity to sell if you wanted to just take the bounce and get out. But if you're a long-term holder, then you don't care. You're okay. I don't mind if it takes a while moving to the upside, which is what's really likely, in my opinion. This wave 4 is right near the 61.8% level. So maybe we're going to start that wave 5, but I don't think we're going to get those big volatile moves in Bitcoin like we did when the strategic reserve was announced. Ethereum was actually trying to do something today. I've been joking about the fact that it just isn't cooperating. And when you looked at it on the chart, it looked like, oh, it's a pretty good day in Ethereum. But then you look at the daily chart, and I know it trades 24/7, but it does have a calendar rollover, so it gives you a pricing bar, just like any other daily chart does when the market closes, so that you can look at technical indicators like Elliott wave on it. And we're just consolidating right here around 2000. It looked like maybe we needed to come down to 1500, and we might still need to come down to 1500 on Ethereum. So when you look at it and say, oh, Ethereum was having a good day, it's still below its 10-day moving average. So these bounces don't mean anything. Don't think that the downward move is over when you get these bounces, especially when they're oversold and the bounce doesn't even bring us back to the 10-day moving average. XRP, the one that the meme crowd is so crazy about, it's been doing a little bit better than the rest of the cryptos have been. You can see we haven't had quite the downward movements. We had the big rally post-election like all the cryptos did, but this one's held in there really well. And we drew this line. And last week we were wondering, oh, we're in danger of breaking this uptrend line here where we're setting up a pattern of higher lows. Technically, we broke it because that low took out that low. So really, this is not a correct uptrend line, but we're still kind of holding in that neighborhood. We haven't had the big downward move in XRP as we have in some of the others. So we'll see if we can make this wave 5 move back to the upside. And then you wanted me to put Cardano back in. Again, just trying to limit the symbols and limit the amount of time that you spend watching this, but you ask about it, so I'll put it back in. And I told anyone I can think of on the big spike on that Sunday. Cardano had arguably the biggest spike. It was over 60% on that news on that Sunday. This big, huge spike because people were surprised that Cardano was listed in with the other cryptos that I just went through and mentioned as being part of the strategic reserve. And hopefully people listen. I talked to everybody. I said, you ought to get out of your Cardano. You want to hold some of the other ones longer term, like XRP, etc., Bitcoin, but this is a good opportunity to take a nice gain on Cardano. And I was actually right because it came right back down. And it's consolidating right here around 75. I don't know if we get much more of a move here. We'll see if we can get a little better triangle formation. Maybe we're starting one here, but it's too early to actually say that we're building a triangle. Maybe in the next week or two, we have a little more information. And maybe we'll form another triangle that could yield a breakout in it. But I'm a little more concerned about this one than others. And I think hopefully you took that opportunity with that big spike. And it was because of the surprise nature of it. All right, let's go to the dollar real quick. Lots of commentary on the dollar. We actually had the past Dallas Fed governor was talking about the dollar being questioned on the early morning session of CNBC this morning. Actually was doing some speaking in Florida yesterday. Traveled early this morning, so no sleep, didn't go to bed all last night, been up for over 24 hours here. So I was watching the early morning market stuff, and he was talking about how the dollar has come down and there's reason for it to come down, but you don't want it to get too weak because of the amount of debt we have and the amount of treasuries and bonds that we auction off every week because of all the debt. You still want confidence in the dollar, but you don't want it to go too high either. And I've been saying that I thought we got a little too high. There was a really unusual move to the upside, and that hurts companies that trade internationally because of the exchange rate. So I would like to see the dollar consolidate here. I do agree you don't want it to get too weak because if we lose the dollar with the amount of debt we have and people lose confidence in the dollar, then we're in a world of hurt. We have all kind of problems that haven't even been discussed yet. So this big move down, let's consolidate in here. The fact that the wave 4 is at 85% means this 5-wave pattern is disqualified. Some of you ask, well, if it's disqualified, why does it still show it? Well, the way the algorithm works, and you have to read Elliott's works, not just his published works, not just the general stuff on Elliott Wave, but his notes, and that's what I've done. So Elliott had rules, guidelines, and notes. So those were his observations. So I call them rules, guidelines, and observations from Elliott. And in the algorithm, it will still label it here. It won't disqualify, in fact, meaning that the 5-wave pattern won't go away until it takes out that wave 1 high. Once it does that, then there will be no 5-wave pattern. But yet, Elliott noted in his writings that you pass that 78.6% fib level is a disqualified pattern. But for whatever reason, I don't know what he was thinking. He wrote it. It's an amazing technical indicator, but that's why it still shows it there, even though you know that because that's wave 4, that's disqualified. We're not going to have that wave 5 move up in the dollar. Now, perhaps the dollar moves higher, but it'll be a new impulsive pattern if that's what occurs. So we'll see where the dollar goes. But I would like to see the dollar just kind of hang in this area from 104 down to the support level at 100 that we had back in September, October. I think if we stay, and this is the upper end of the range, we don't really want these scary moves down, but just some sort of churning between 100 and 104, I think would be very constructive for the equities market, especially now that the Fed fund futures are pricing in more rate cuts. I'm still suspect of that, but if we get them, it'll be positive for the markets. But to get there, we have to have a dent in the labor market, which that's not good for anybody. Nobody wants to be in fear of losing their job, et cetera. So, we're in that in between uncertain period here, and it's difficult to figure out. Now let's go to some stocks of interest, and we're going to look at Apple. And I talked about this with Apple, the fact that this is the one stock that I fear shorting, and I've feared it for my trading career. And when you come up with a viewpoint like that, it's because you've been burned in the past. And I was burned in the past when Apple would break support and you think, okay, here's a big move down, and they step in because they have so much money. And that's the commentary that I've made on Apple. And somebody made a comment on last recording of the one before. Rob says, don't short Apple. That's just my experience that I've been sharing. So no, I typically don't short Apple. I did talk about it during TradeFinder last week that, if we don't hold 220, we're coming down to 210. So I did say that, and that's exactly what happened. But did I put a bearish trade on? No, I didn't, because I follow my disciplines, and I've been burned on it too many times. Last time we got down to 220, they stepped in and bought, or at least it looked like they did. Maybe they didn't, because when you put the volume on here, I was just speculating that maybe Apple came in and bought. It was a support level. Maybe it was just a typical bounce, a technical bounce off the 220 support level, because you can see there wasn't any real big volume bars here, big green bars to indicate that Apple was coming in and buying more shares. But they do stock buybacks all the time, and they have so much money that they just decide, unless you have privy to their boardroom, you don't know when they're going to do it. So now we're at 210. Will this hold? Maybe. We're a little oversold from the 10-day moving average. We broke 220, went down to 210 on the news that Siri, the new version of Siri, is going to be delayed. It was going to come out this year. It's not going to come out until next year now. And so that's what pushed Apple down and got it to 210. It's kind of a little bit in no man's land. If I condense the chart, you can see that there was a little bit of trading down in this area back in the end of summer last year. And then we tested it at the end of the summer, moving into fall. But then 220 became the range. But look what happens here. If we don't hold 210, then we're back down at 200 rather quickly. Now, that doesn't have to be the fact that here's one of those vertical moves, and you hear me talk about that as one of our rules too. I don't like it when things go vertically up, because oftentimes they come vertically back down. So you retrace the vertical move. Well, we already did that back here on this move, but that could actually end up being a support level here at 200. So we've already satisfied the rule of retracing a big vertical move. But look where that wave 2 was back at the end of 2023 is also right there at 200. So it might not happen quickly because we are a little bit oversold on Apple, but I wouldn't be surprised if Apple works its way down to 200. I still personally wouldn't short it, but that's just me. And I'm just sharing with you the things that I've experienced over time. You just don't know when Apple's going to step in and start buying a bunch of shares, and the people that have the stomach to short Apple, they get burned when they come in and buy the shares, because then the short covering happens and they get a rally to the upside. But while I'm talking about the comments left on the videos, I wanted to remind you, we're doing just what we did last year. Every month this year, we're giving away a free copy of our level 3 subscription. It's not really a copy, it's a subscription. And the level 3 covers our 3 primary portfolios. The time strategy, which is AI based, looks for stocks that have had a big drop, so they have a spike in implied volatility. And then we put on a spread to take advantage of that, like a time spread, calendar spread, or butterfly, something along those lines. But the stock's expected based on the AI to stay in a 1 standard deviation range. So we're just collecting premium. So it's not a get rich type strategy. It's a slow income strategy. Then we have the volatility strategy, which is those triangles with the unique way of doing strangles that I explained before. So you find triangles, you put those on. Then we don't care what direction it moves, just as long as it breaks out. You can see how Apple broke to the downside out of this triangle that was formed here. As enticing as that was, I didn't do that either. So that's what we get in the volatility portfolio. And then we have the AI-based time strategy, the AI-based impulse strategy, which is directional in nature, and that highly features zigzags within a wave 3 that I talked about earlier. So I've begun a lot of Elliott wave talk and education in this. You can see, again, we're a little oversold here. Maybe we bounce off 210. But it wouldn't be shocking for me to see 200 come into play, but it also wouldn't be shocking for me to see volume come in as Apple initiates another stock buyback, and then this breakout of the triangle becomes the end of the move. So if you want to be real aggressive and you see it breaking 210, you're probably going to get to 200. but I won't be there with you. If you want to do it, go ahead. But maybe we need to get a little bit of bounce, even come back and test 220 first. And so talking about those subscriptions, the level 3, if you go to the website, you can see it's thousands of dollars for the subscription of all 3, the level 3, including all 3 of those portfolios. So you get trade alerts on all 3 of the portfolios. But we're giving away one free every month this year, just like we did last year on these YouTube videos that we do each and every week. And the only thing you have to do to register for the giveaway is leave a comment under the recording. So leave a comment and you're automatically registered. And I know a lot of you are looking for them. Wish everybody best of luck. It's a pretty great deal that we're giving away. And again, you can go to our website at ewotrader.com and see what the value is. I read every comment that y'all write. Now, I'll answer as many as I can, time and travel permitted. Haven't had a lot of travel with speaking engagements here over the past couple of months, so I haven't been as prompt on responding as I usually am, but I read them all. But maybe you care, maybe you don't, but all you have to do is leave a comment and then you'll be in the drawing. And one other thing I wanted to mention, we're pushing towards 50,000 of subscribers on our YouTube channel here. Love to hit that number. So if you know anyone that you think might enjoy these videos, please recommend them and get them to subscribe. Hit the subscribe button. We like the likes, but we like the subscribes too. Love to see us get to 50,000, that big round number. So we're pushing there. Would appreciate your help and support there. So other stocks of interest to talk about. We always ask about Palantir. So let's go ahead and look at Palantir real quick. And this could be getting interesting. I mentioned this last week as well. We're consolidating here, and maybe once again, if you had some speculative money and you have aggressive, you're aggressive by nature. Everybody knows their own risk tolerance. Some people are more aggressive, some people more conservative. So I usually try to give both views. If you're aggressive, we are trying to hold this top here, the support level that was resistant a little bit back here at the beginning of winter, and then here at the end of winter. Or the middle of winter, and then we did it again in January, and now we're trading through it right now. If we can hold this level right here around 85, perhaps we do have a wave 5 to the upside. So we had the vertical move up, we retraced it. What goes vertically up oftentimes comes vertically back down. Nothing gets too far from the 10-day moving average for long. We've satisfied all those rules, and we have a wave 4 that's purple. So the algorithm thinks that wave 4 may be in. So if you do want to look from a speculative standpoint, perhaps you could dip your toes into Palantir and see. You might have to have the stomach to hold it if we move down here, because that's where the next level of support is. Or you could just say, you know what, I'm going to step in here, but if it breaks 85, I'm out, because I don't want to hold it all the way down to the 60 level or so, which is where that next level of support is. But it is getting pretty interesting here. Now, if you're a little more conservative, let it get back above the 50-day moving average first. Don't just look at this support level as holding for some sort of a bounce. Let it get back above the 50-day moving average. We got NVIDIA that seems to have caught a bid. That's not in this recording because we've been doing that over the last few weeks. Again, can't show every stock every week. Otherwise, these recordings would be hours long. So I do try to respect people's time when it comes to that. So you did ask about ELF. Talked about that one a couple times. And something interesting about ELF, you can see it as an AI score here. So this is the AI score following a drop that we utilize in the time strategy. In other words, it looks for this standard deviation. That gives us our boundaries, an upper boundary and a lower boundary. So if you want to put on a butterfly, you know where to put your wings, etc. I like calendar spreads on these. So there's the big drop. So we have volatility rushing into the options. We can take advantage of it by some sort of a spread. But the AI score is only 30%. So what that means is that the AI is saying, we're not so sure we're going to stay in this boundary. In fact, on a lower score, you can fade these moves, but the data scientists at Hub tell us to fade them, let the score be below 25. So it's 30% wouldn't be enough. So far, it's kind of stayed within these boundaries, but with a score that low, there is a potential that it could break out of one of the boundaries. That's what it means. And so when we get these low scores on these, instead of using it as a sideways strategy, then we use a strangle because it's expected to break one of the boundaries. So there's all kinds of different ways to use the AI signals. So you have multiple and numerous opportunities to put on trades. But what's interesting here is you can see ELF had this big move down. It's been going sideways. The AI isn't so sure we stay there for much longer, so perhaps we get some sort of a movement here. The wave 3 is still green, so the algorithm's not sure that's the low. It's not sure the low's in, so we could actually move lower. But staying in the same space, ULTA announced their earnings. They had a good earnings report, but they had very poor guidance. And this shows you how hard trading is right now, because you've had stocks that have had a good earnings report and weak guidance, and they got crushed. And then you have stocks like ULTA that had good earnings, weak guidance, and we rallied today. We had a big move back to the upside. Now, granted, again, we were a little bit below the 10-day moving average. We also tested that wave 5 low from back at the end of the summer. But we did get back above the 10-day moving average. So that's interesting. So perhaps that could be a precursor that ELF may be poised to break to the upside. We'll have to wait and see. They're in the same sector. So I just thought I'd throw that one in there as a bonus for the people who have been asking to look at that. Tesla, I know you want to see that. And gosh, what a mess that's been all over the place. Same thing here. The wave 4 is too far down, so that's not in a 5-wave pattern. This will disqualify. We got within a hair of breaking that wave 1 high there, which would have taken the pattern off. But even with the bounce that we've had off of 200, we haven't even gotten back to the 10-day moving average yet. Here's the corridor support that I've drawn. This is where Tesla has all of its support. So we had the big run post-election, too far, too fast. We gave that back. We came back to the 10-day moving average. We got too vertical, so we got rid of the vertical stuff. What goes vertically up comes vertically back down again. We've done all that stuff, and there's a really good corridor support here between 200 and 250. So we're getting a little bit of a bounce here. I don't even think if you're aggressive and have speculative money to put to work that you want to jump in Tesla yet. Let's let it get back above 250, get back above the 10-day moving average. If you're conservative, then you'd wait for the 50-day moving average. So even the most aggressive people, I think you need to wait and let it see it break 250, the Missouri thing. Show me. But it is at least trying to hold in an area that you would expect in this corridor going back to last fall. And into the winter time. Going back to the commodity sector, we did gold and silver. You ask about uranium, URA. It had moved down, and it's trying to find its support here. Once again, just an amazing pattern here with Elliott wave. I left this one on here, but I can take this one off, this zigzag pattern here that went down to the 100%. So there it was right there, and then down to the extended level at 161.8. So that zigzag did take that extended level that I was talking about. So I'm going to go ahead and take this one off. But we have another zigzag here that's current on uranium. We had a 70% B-wave correction. So we stayed under that 78.6% level, which left this zigzag still qualified. And then we moved down to the expected move at 100%. The only question is on uranium, do we go down to 161.8? Note that we have not bounced back to test that previous fib level, which would be this level at 27.5. So if you see uranium bounce up and you want to be speculative and get back above this 100% level, you want to be cautious once it gets to 61.8 and 27.5, because that could act as a lot of resistance, not just because it's the previous fib level that it would test, but you also can see that looking at this, that was a point of support back here at the end of the year last year and early part of this year, right in that 27.5 level. So I broke it and just went vertically down quick. And now we're trying to consolidate here a little bit. Another small triangle, so not projecting too big of a move, but something likely to happen. And that wave 3 is still classified as being an active wave. A break to the downside of this triangle would bring you right about to that 161.8% level. A break higher would get you back above the 10-day and testing the 50-day and probably testing this resistance at 27.5. So most ideal trade on uranium right now, I think, would be to try to trade this triangle. I haven't looked at the option prices to see if the delta gamma relationship is good enough with a low enough IV to make it worthwhile to do it. It could be just wait for the breakout and trade the directional move once it breaks out of the triangle. So I went ahead and showed you ULTA. So that kind of wraps things up for everything this week. I will show you Solana. I don't think I showed you that during the crypto stuff. So we'll add that one in. Just like we talked about with Ethereum, needed to hold that level, which is trying to break down below. Solana has that same mode here. You can see how important this level where we're trading right now is to hold, because if we don't, we're going down to this next level, and it probably happens rather quickly. But this has that kind of corridor like Tesla does, where even if it breaks this first support level, there's another support level not too far away. But you can see, again, the importance, how many times it tested that level to move back to the upside. So I thought I'd do a little bit more on crypto with the news, and then the speculation of when the government's going to buy, how much they're going to buy, etc. So as always, thanks for viewing. Appreciate your time very much. Have a wonderful weekend, and look forward to talking to you again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.